Good morning, everybody, and welcome to today's webinar on struggling with Brexit. So just to give you a heads up, today's presentation will mostly be on the VAT and duty elements, but there will be additional considerations that we need to take into account. So let me just move on to the next slide. So obviously I'm a client manager here at Seymour Taylor, and everything that we are going to be talking about today is correct at the time of this presentation. That's obviously an important thing with ratification currently going, with the agreement going through the ratification process at the moment. So, the Trade and Cooperation Agreement. From the 1st of January 21, the UK left the single market, customs union and free movement agreement. This means that there will be no tariffs or quotas on the movement of goods we produce and now export from the UK to the EU. This is the first time that the EU has agreed a zero tariff, zero quota deal with any other trading partner. Looking at the VAT changes arising from the Trade and Cooperation Agreement, known as the TCA, it may be better not to think of this as a free trade agreement in the sense of total freedom of trade, but rather as a preferential trade agreement. Although there remains freedom in terms of moving goods between the UK and the EU, there are many additional measures that businesses and individuals will have to consider. As you will all appreciate, there have been an awful lot of changes, and one thing that is for sure is that life won't be as free and easy or as frictionless as life was within the single market. The agreement is noteworthy in the sense of there being no customs duty tariffs on the movement of goods between the UK and the EU, but that is subject to a number of conditions, primarily around origin, which I will come back to. The agreement itself is over 1,000 pages long, and so it will continue to be a challenge for us all to get to grips with. At the moment, the agreement is provisional until at least the 28th of February. However, there is every expectation that this will be ratified by the EU. At that point in time, we would certainly welcome additional guidance in respect of services, given the focus so far has been on goods. Looking through the headlines on the next slide, there are still some formal steps towards ratification at the EU end, but the basic frameworks are here to stay, and although the headline has been that trade is tariff and quota free, this doesn't apply to all transactions, and there are a number of additional considerations, particularly around the origin of goods. So if we turn our attention to some of the main headlines, it's one of those things where, unfortunately, a lot of these things are relatively heard of in that a lot of them we've been made aware of, but there are some extra things that not many people have been made aware of by the government. So, as I mentioned earlier, the focus of today's webinar will be primarily on VAT on goods and duties, rather than the changes to treatment on services. Perhaps there might be a third webinar to the series where we cover services, but we'll wait and see. So if we turn to the headlines themselves, some issues have been expected while others less so, arising mainly from the daily updates to the official guidance and political changes. The past 2 months have involved a lot of fine-tuning as to how this will eventually operate. One thing that we have certainly witnessed is the additional administration burden that is prompting some clients to examine and review their supply chains. This means either doing things differently, questioning whether they should stop some activities, or reviewing their commercial agreements with suppliers and customers. There is some welcome news for businesses that are now importing or exporting to the EU, in that there is a £2,000 grant available to help with the additional administration burden. We will upload some guidance on this in the chat function at the end. So if we turn our attention to some of the welcomed changes, the first thing that I should say is that we're pleased that now we're at least moving forward after essentially 4 years of trying to second guess what these changes might be. The challenge from speaking with many clients over the past few weeks is that we haven't had any significant lead time to see what all the changes are and then to get to grips with them. Unfortunately, we've had to hit the ground running by having to deal with both Brexit and the COVID-19 pandemic. The main headline, of course, is that there have been no quotas or tariffs introduced for trading goods between the UK and the EU. However, this is only true where goods are of UK origin, and that's a really significant point. There have been some simplifications to VAT, as there are fewer boxes to complete on the VAT return, with boxes 8 and 9 now being specifically for Northern Ireland only. The VAT on entry is now included in boxes 1 and 4, and those businesses who aren't partially exempt will therefore notice no difference in box 5. Additionally, the administration burden of completing an EC sales list has been removed. There are also reduced interest at return requirements. There is no longer a requirement to register when goods are moved from Great Britain to the EU. Instead, an interest at return is only required if your business receives more than 1.5 million worth of goods from the EU or moves more than 250,000 worth of goods from Northern Ireland into the EU. So postponed accounting is one of the reliefs that the government have permitted for import VAT accounting. This removes the cash flow cost and deferment requirements at import. For example, when goods were imported before Brexit from outside the EU, import VAT would have been collected at the point these goods entered the country to enable the goods to enter into free circulation. If this happened on, say, 1st of January 2020, the VAT would have been payable then, and the VAT would have been recoverable on your next VAT return. Let's say the quarter ended 31st of March. You would therefore be able to claim relief on 7th of May 2020, some 4.5 months after you actually incurred that cost. However, if we move forward 12 months and those goods were actually imported on the 1st of January 21, the import VAT would no longer be payable on entry. As noted before, it would be included on that very same VAT return, obtaining immediate relief. Additional relief has therefore been available in that there is a significant cash flow advantage. Of course, in reality, this is no different to how the acquisition would have been treated prior to Brexit for goods coming into the EU. Another possibility for deferring the VAT prior to Brexit would have been through the use of a deferment account. However, there are additional associated costs in terms of cash or a bank guarantee. The important point to note is that you don't need a deferment account to use postponed accounting or to apply this treatment. You simply need to elect for it by ticking the relevant box on the import documentation. Additionally, there is transitional relief for goods that were sold pre-1st of January but delivered afterwards. These goods are treated under the old pre-arrangement rules. We are seeing small items like this in the guidance, which are a long way from the headlines, but helpful nonetheless. There are also some relaxations around the requirements for indirect exports. This is where your customer is responsible for collecting the goods and transporting them out of the country. For example, the UK has now got freedom on zero rating now we're no longer part of the EU. So, in the past, where the UK had removed zero rating, we could go back to 5% and make things simpler. If we now turn our attention to import VAT, goods that move from the UK into the UK from the EU from the 1st of January will be considered imports, meaning import VAT will be payable and customs declarations will need to be made. Businesses must account for VAT on all goods imported using a postponed accounting system. As previously mentioned, this means any import VAT on goods is accounted for and paid via the company's usual VAT return, rather than paying it immediately at the point of entry. In fact, if a business already imports from outside the EU, then it might see cash flow benefits too from the new system because it essentially removes the need to account for the import VAT typically due. This also applies to goods imported by VAT-registered importers to the UK from anywhere in the world if they're worth more than £135, including those from the EU. In most cases, import VAT should be recoverable by the business. Duty deferment. Businesses that import goods regularly can set up a duty deferment account, which allows them to delay paying most customs charges, including import VAT. This allows businesses to make a single cash payment each month instead of paying for each consignment separately, as you would under the postponed accounting scheme. You can pay the duties and import VAT deferred during one calendar month as a total, either on the 15th of the next month or on the next working day after the 15th if it is not a working day. This means that you can defer duties and import VAT for between 2 and 6 weeks, offering an average of 30 days credit. Regardless of the method of accounting for VAT on imported goods, checks to ensure that the data on the customs declarations is accurate will continue to be highly important during the VAT purposes. So you might be questioning whether you should use postponed accounting or duty deferment. With postponed accounting, you automatically record and pay on the VAT return rather than at the border. This helps with cash flow. But you must do this for each consignment that comes in. With duty deferment, all consignments are combined into a single payment via direct debit, and it allows import VAT to be deferred for potentially longer than under the postponed accounting method. This system is really intended for those exporting regularly and handling a large number of consignments. VAT registration and place of supply. Businesses must determine the country where the supply takes place for VAT purposes. This way they know where the VAT due is payable. Businesses should also be aware that they may need to create VAT liabilities in other EU member states, and therefore may need to register in those other member states. This could mean that businesses in the UK require multiple EU VAT registrations within each member state that they trade within. So, consignments of value below £135. Imported goods in a consignment not exceeding £135, excluding specific excise goods and gifts, will not be subject to import VAT at the border and will be subject to sales or supply VAT instead. This means that businesses selling goods will be imported into the UK with a value not exceeding £135 will be required to charge and collect any VAT due at the time of the sale. For VAT registered businesses importing goods in a consignment not exceeding £135, that is not being charged VAT at the time of purchase, they can account for this VAT on their VAT return under the usual reverse charge mechanism. Online marketplaces, where they are involved in facilitating the sale, will be responsible for collecting and accounting for the VAT. Additionally, with effect from 1st of January, the distance selling rules are no longer applicable, as the UK is no longer part of the EU. There is no VAT registration threshold for businesses established outside the UK, so businesses will be required to register for VAT on any value of sales where you become liable for VAT under these new measures. Exports. When exporting, businesses in certain industries will be responsible for checking, first, what export licenses or certificates they require. Second, the marking, labelling, and marketing standards for food, plant seeds, and manufactured goods. And finally, the rules for exporting and importing alcohol, tobacco, and certain oils. Again, on exporting the goods from the UK, you will be required to provide details of your EORI number for customs declarations. One significant issue that has come to the fore in the news most recently is that of origin. The highest profile case at the moment is that of the Percy Pig sweets sold by Marks and Spencer. The important point here is that generally no duty is payable when there is value added in the UK. In this sense, the product has changed sufficiently in the UK to change its origin. If we now turn our attention to assessing the rules of origin, the first step for a business is to determine what goods are being traded. The World Customs Organization has a list of classifying every product traded under a tariff heading. Each product has a unique code which is grouped into broader categories. Once the good has been categorized, the next step is to establish its economic nationality, as opposed to simply the country it came from. This involves determining the good's value and where the contributions were made in adding value to that final product. If all materials were obtained and processed in one state, then it would simply be wholly obtained in that country. That would apply, for example, to agricultural products, raw materials, and natural resources. But consider for a moment a car. It may be made up of thousands of individual components, down to individual nuts, bolts, and bulbs, each of which come from a different supplier from around the world. With multiple components adding value, it can be very difficult to determine origin for some products. In this case, the final product is determined by the location of the last substantial transformation. In terms of preferential origin, substantial transformation is defined through one of or a combination of three main criteria. The first of which is a change of tariff classification. So, when the work undertaken in a country results in a change of classification, for example, the unique code for car parts is 8708. This is different to the code for a finished car of 8703. Second, sufficient value is added. In this scenario, the originating state must contribute a minimum percentage of the value of a product. Each component will add a certain amount of value. And finally, specific processing. Finished products can qualify when specific work or processing activities are carried out. This can involve importing goods and then repackaging, branding, and putting into being able to put it in a position where you're able to post it to customers. The VAT rules are very detailed and can change for each product depending on what is agreed in the free trade agreement. Typically, for preferential origin, such as is found in the new trade agreement, more than 50% of value has to be added to claim origin, but that differs for each classification of goods. From 1st of January 21, in order for businesses to benefit from preferential tariffs when importing into the UK from the EU, they must claim preference on their customs declarations and declare that they hold proof that the goods meet the rules of origin. This can take the form of a statement of origin completed by the exporter on a commercial document, or acknowledge the document through the importer that the goods are originating in the UK. If preferential origin isn't met, then it is likely that these goods could be subject to double duty. If we consider the case of a car, then the car parts are manufactured in the US and then shipped to the UK and onto the EU. There is no value added in the UK, and so duty would be payable on entry to the UK and then most likely again on subsequent entry into the EU. The UK and EU have agreed a 12-month grace period. This means that until the 31st of December, businesses do not need suppliers' declaration from business suppliers in place where the goods are exported, but they must be confident that the goods do meet the preferential rules of origin. Businesses may be asked to retrospectively provide a supplier's declaration after this date. And of course, it is a requirement to maintain and hold your records for at least 6 years. If we now turn our attention to some of the direct tax implications. So the first I would like to bring to your attention is the Parent and Subsidiary Directive. This abolishes withholding tax on payments of dividends between companies in different member states, and the double taxation for parent companies on the profits of their subsidiaries. It is likely, however, that dividends from UK companies paid to parent companies based in other member states will not be affected, as the UK does not generally impose withholding tax on dividend payments. Additionally, Brexit has removed the benefit of the Interest and Royalties Directive. This means that the payment of royalties or interest to a UK company can be subject to withholding tax. The UK has previously been heavily involved in the existing EU Tax Transparency Initiative. This is known as Base Erosion and Profit Shifting, or BEPS for short, and would remain committed to these international standards on tax transparency. State aid. State aid was a big political hot potato, as you may recall during the negotiations, but there are some tax incentivized investments and tax incentives that we in the UK give to help investment into corporates. Typically, these schemes include SME R&D relief, EMI share schemes, EIS relief, SEIS relief, and VCT relief. These incentives were restricted by the EU state rule and limited the number of companies who were able to benefit from such state aid based on a number of factors, including the size of the company, the number of employees, and the nature of the company's trade. Now, under the Trade and Cooperation Agreement, the UK will pull away from the EU state-imposed provisions. However, we will be looking at putting in our own equivalent provisions. So at this point in time, it's very much a case of watch this space in terms of what rules may come in and what impact they may have on the various tax reliefs that were previously restricted under the EU state aid rules. Overseas holiday homes. As you would expect, we've also been asked several questions around overseas holiday homes. It is important to note that there is an impact on the ability to travel freely within the EU, as there is now a maximum length of stay of 90 days in any 180-day period. This rule applies to the whole EU region. So if you were to go from Germany to France and then down to Spain, the 90-day period covers that whole duration rather than enjoying 89 days in each country. From an income tax perspective, a secondary issue arises in that a large number of EU countries tax their non-residents based upon whether they are resident within the EU or EEA. Generally speaking, there are more favourable tax treatment for individuals who are EU residents compared to those who aren't. By way of an example, the rate of income tax that non-resident British nationals would have to pay in Spain has increased from 19% to 24% from the 1st of January. In addition to this higher rate of income tax, there is less flexibility in terms of expenses which can be deducted from a holiday home. This means that gross income will be taxed so that those people who have been deferring repair expenditure could be put at a huge disadvantage. We now turn our attention to some of the VAT simplifications. So I first wanted to highlight some of the simplifications that we'd enjoyed as members of the single market. The first of which was that of triangulation. For those of you who are less familiar with this, the concept works as follows. If you, as a UK supplier, had a customer in France and you had agreed to supply them with goods sourced from a supplier in Germany, then you would almost certainly trigger a VAT registration requirement in France in order to receive the acquisition of the goods from Germany and make a normal domestic supply in France. The triangulation rules were a welcome simplification, which meant that you could avoid needing to register for VAT in France and could account for the transaction in your UK VAT return. However, this simplification is no longer valid as it requires all parties to be resident within the EU. Some businesses have considered setting up a subsidiary located in another EU member state as a means of getting around this, in order to benefit from the triangulation rules under the EU scheme. Additionally, they could have an EU hub through which they could deal with the EU and also a base in the UK to deal with the rest of the world. The advantage of this would be that the sale could be treated as an EC sale, as was the case before Brexit. This would simply shift the reporting requirement into another EU member state. The issue with this, that we have already seen instances where there is a requirement to register for VAT in the EU state they are dealing with, which ultimately means an increased compliance cost and the additional burden of having to potentially appoint a fiscal representative. We had also previously benefited from the Mini One-Stop Shop, or MOS for short. This dealt with online digital services being sold to EU customers. The simplification here was that one single VAT return was required and that the MOS scheme would act as a clearinghouse. However, this is no longer possible. The proposed replacement for this is a VAT one-stop shop, which is expected to be effective from the 1st of July. However, this doesn't help for that interim 6 months. Finally, as a result of the UK leaving the single market, there is now going to be a more convoluted process for claiming back VAT incurred within the EU. Previously, there was a portal on the HMRC website that could be used to recover VAT incurred in other EU member states. However, this scheme will only remain in place until the 31st of March, so time is very much running out. Northern Ireland. Trade with Northern Ireland has generated a fair few queries and tend to be very specific to do with the special status of Northern Ireland. If you are supplying goods from Great Britain to Northern Ireland, then normal VAT rules apply and you charge VAT to your Northern Ireland customer. At the same time, Northern Ireland is treated as part of the single market for goods under the provisions of the Northern Ireland Protocol. This essentially treats Northern Ireland as being part of the UK and also the single market for the purposes of goods. Under these provisions, Northern Ireland will abide by the EU rules at all of its ports, which allows it to keep its border open with the EU, therefore avoiding a hard border between Northern Ireland and the Republic of Ireland. If you move goods into Northern Ireland or via it to the EU, then you should also sign up for the government's Free Trader Support Service. This free-to-use service is available for businesses of any size moving goods into Northern Ireland, providing guidance, training, a digital declaration support service, and support from customs experts. If you move goods between Northern Ireland and non-EU countries, which now includes Great Britain, you will also need to apply for an EORI number with an XI prefix. In order to apply for one, you must already have an EORI number that starts with GB. VAT on services. As I mentioned earlier, there hasn't been a lot of guidance in this area. However, I just wanted to summarise some of the important points here. Post-Brexit, there should be minimal impact on the supply of services. Business-to-business services are treated as though they are supplied where the customer belongs, and that customer must account for the local VAT. This will mean that for UK service suppliers, they will continue to not charge UK VAT. For business to consumer supplies, the UK VAT generally applies, and this will also remain the same. When receiving services, UK businesses may still have to apply a reverse charge to the receipt of services from non-UK suppliers. This ensures there is no competitive advantage from sourcing services via non-UK suppliers. Digital services. After the 31st of December 20, all supplies of digital services to consumers in EU member states are liable for VAT in the consumer's member state. The £8,118 annual threshold for cross-border sales of digital services to EU consumers no longer applies. Organisations will have to charge VAT at the rate where the customer is based and declare those sales to the relevant EU member state. UK businesses that have been previously using the VAT MOS scheme can continue to use the scheme, but must register for the VAT MOS non-union scheme in an EU member state. For businesses wanting to continue using MOS, they must register for the scheme by the 10th day of the month following their first sale after the UK leaves the EU. For example, register by the 10th of March if a sale is made in February. Alternatively, organisations can register for each EU member state where they make sales. Check the EU's Europa website for further information about registering for VAT in other EU member states. Non-UK businesses that previously used the UK VAT MOS non-union scheme will now need to register for the scheme in an EU member state. Non-UK businesses need to declare sales of digital services to UK consumers by registering for VAT in the UK and declaring the sales via their UK VAT return. To declare the VAT charge, businesses can register for VAT in each EU member state where sales are made or register for the VAT MOS non-union scheme in an EU member state of their choice. As of the 1st of January 21, businesses are no longer able to use the UK MOS scheme to report and pay VAT on sales of digital services to consumers in the EU. Businesses that sell digital services to consumers in the EU have to register for the MOS non-union scheme in one of the remaining 27 EU member states. The Institute of Chartered Accountants in England and Wales understands that many businesses are considering doing so in Ireland. Under the non-union MOS scheme, businesses wishing to use the scheme must register by the 10th day of the month following the sale, as mentioned previously. So, what are the next steps? Businesses should review their supply chains and international tax strategies to determine whether and to what extent they should be adopting alternative and cost-efficient approaches to affect business in a post-Brexit environment. Supply chain issues remain a key risk, particularly if future shipments encounter difficulties at the UK or EU border, including increased costs and delays. Businesses will need to take a commercial decision on whether it is in their interest to meet and prove that they meet the rules of origin in order to benefit from the TCA's zero tariff treatment. Business supply chains also need to understand the new self-certification procedures for proof of origin and address the risk of non-compliance or customs authorities' inquiries. Businesses that have relied on EU VAT simplifications to avoid multiple registrations may need to consider a number of options. Firstly, restructuring their supply chain in order to transport arrangements to obtain an EU VAT number, warehousing goods for the EU market in the EU, or setting up a new EU establishment. Businesses should likewise ensure that they are familiar with the procedures and additional administration required for VAT and customs reporting on imports and exports into and out of the EU and UK, as well as non-tax regulatory requirements. So, we are standing by to support businesses with the complexities created by post-Brexit trade, including the challenges of VAT registration and import VAT. We understand that during this difficult period, it can be difficult to balance the needs of complying with Brexit and the other important day-to-day tasks of running a business. If you would like carefully tailored business, tax, and accountancy advice related to any of the points covered in this guide, please do contact us. We will now add a link to the resources page of our website where additional information is available on Brexit, and you can also view the guidance on the £2,000 grant I mentioned earlier. Thank you for listening. We will now turn our attention to some of the questions in the Q&A section. So, one of the first questions that I've been asked is, what are the differences between exporting to EU customers versus non-EU customers? So, generally speaking, you should notice very little difference in terms of exporting to the EU and outside the EU in terms of the process. The TCA is aimed, that's the Trade and Cooperation Agreement, is aimed towards simplifying the VAT and duty elements as follows. So in terms of VAT, you can zero rate most exports from GB to any destination outside the EU. This is the same for EU and non-EU countries. Duty. Duty is a bit more complicated, but the rate of duty will depend on the goods being exported and the country they are being exported to. However, as I mentioned earlier, please also consider origin. There are different rates of duties in different countries for some goods. The duty to and from the UK can generally be found on the HMRC Trade Tariff webpage. I'll shortly find a link to that and pop that into the chat as well. So, bear with me 1 second and I will just find that website link. So, I'm just popping the link to that webpage in the chat at the moment. So there should be a link in the chat for everybody to use. So I have another question in terms of what is the process when imports coming in are not invoiced to us or owned by us? So here, that very much goes back to the question and simplification I raised earlier on triangulation. If it's okay, I will respond to that one separately as it does get quite technical, if that's okay. Does anybody else have any additional questions? So I do have another one in terms of how do I record this in our software? So this is actually quite a difficult element that we've been experiencing. Each of the software providers are going about this in a different way. I understand that recently Sage have issued an update for their the software that you install on your PC, and there are obviously other software providers out there that are treating this in a different way. So what I would recommend is at this point in time, probably getting in touch with the software provider directly and asking what should be the correct VAT treatment. Not necessarily in terms of the treatment you're asking for advice on your export or import, but what should be the relevant VAT code that you select when entering the transaction into Sage? Um, so I have another one. Is VAT applicable for the sale of non-digital services to non-UK customers? So in terms of services, if you bear with me, I will just go back to this relevant slide. So I think this is the relevant slide. So in terms of the sale of non-digital services, this will very much depend on whether the sale is being made from a business to a business or a business to a consumer. So if we were to consider the case of business to business, then the sale is essentially treated as though it was supplied where the customer belongs, and therefore the customer must account for the local VAT. This will mean that if you're supplying services to a business outside the UK, then you will not charge UK VAT. Where, however, you are supplying services to a consumer, UK VAT will generally apply. So I hope that answers that one. So I have another question in terms of preferential origin. Does this have to be in the UK or can it include the EU? i.e., if I'm treating and return to sender. So where it is a direct return, then it shouldn't, then no duty should be applicable, because ultimately you're just returning that item from wherever it came from within the EU. However, in terms of the paperwork for doing so, there should be a box on the import documentation when you send it back out of the country to say that it is in fact a return rather than additional goods coming into the country, or an export from the UK to, say, your supplier in, I don't know, say Spain, for example. So I hope that answers that question. So, final question. Our company has purchased goods from outside the UK into Germany. We now want to move these goods to the UK business and sell in the UK. Will we pay double VAT? So this comes back very much to that original point that I mentioned in terms of double duty and the Percy Pig example. Generally speaking, where goods are imported from Germany into the UK, you will include the VAT on your VAT return in box 1, and you'll also recover the VAT in box 4. Ultimately, then meaning that box 5, there's a nil entry there. For duty purposes, it will very much depend on whether those goods that you're transporting from Germany to the UK have been substantially transformed in Germany to warrant actual origin moving from say, the US to Germany. I have had a case for another client where they were importing mechanical parts from the US into the UK and simply storing them here before exporting to customers within Europe. In that scenario, they were subject to double duty, I'm afraid. So hopefully that answers that question. But what I'll do is I'll move these slides to the very final slide, just because they have our contact details on. That way, if you do have any additional questions, please do drop me an email or feel free to give me a call, and I would be more than happy to come back to you with any extra questions. So just one final check to see whether there are any additional questions. So there is one final question within the chat in terms of why do we still need to complete Intrastat forms? I thought that was for movements between the EU and between EU states. So that is correct. Intrastat is only required in the UK when under two circumstances. So the first of which is when you are exporting goods worth more than 250,000 from Northern Ireland into the EU, or if you're importing goods of value of more than 1.5 million from the EU into the UK. So provided you don't meet either of those two conditions, then Intrastat returns wouldn't be required. Let me just see if I can pull up the relevant slide. So hopefully that answers everyone's questions. Obviously, if you do have any further follow-up questions, my email address is gavin.styles@stca.co.uk, or alternatively, you can contact me on either the office landline of 01494 552100 or my direct dial of 01494 552163. If there aren't any more questions, I will end the webinar there. And thank you all for listening, and thank you all, most importantly, for all your questions.